December 26, 2025. Silver crossed $75 per ounce for the first time in recorded history. Not 74.99, 75.14. While most Americans were focused on holiday sales and year-end planning, a metal that trades in fractions of pennies per second reached a price level that seemed mathematically impossible just 18 months ago. And in California, a state representing the fifth largest economy on Earth if measured independently, search queries for the word silver have surged to levels not seen in over a decade. Not gold, silver. The question you should be asking is not why silver is rising. The question is why everyday people are only now searching for it, when the institutions that manage the global monetary system began positioning themselves years ago. This is not about speculation. This is about recognition. Delayed recognition of a mathematical reality that has been unfolding in plain sight while most people were looking elsewhere. Let me explain what's actually happening. The number you need to understand is 820 million ounces. That is the cumulative supply deficit in the silver market over the past 5 consecutive years, from 2021 through 2025. 820 million ounces represents an entire year of global silver production simply missing from the market. Not delayed, not in storage waiting for better prices. Gone, consumed, used in manufacturing, in electronics, in solar panels, in electric vehicles, in the infrastructure of the energy transition that governments worldwide have committed trillions of dollars to build. Silver is not a relic. It is the most electrically conductive, thermally conductive, and reflective metal known to science. Every smartphone in your household contains it. Every vehicle produced after 2020 contains more of it than the vehicles built a decade ago. Every solar panel installed on a California rooftop, and California has mandated solar on new residential construction, requires approximately 20 grams of silver per panel. The Silver Institute, the industry's primary research body, projects another 95 million ounce deficit in 2025 alone. Not a surplus, a deficit. Demand outstripping supply by nearly 100 million ounces in a single year. This matters because silver, unlike fiat currency, cannot be printed. It must be extracted from the earth. And global mine production has been essentially flat at approximately 813 million ounces per year since 2020. Recycling adds some supply, but not nearly enough to close the gap. What happens when demand structurally exceeds supply for 5 consecutive years? Price discovery? And that is precisely what California residents and people across the world are beginning to recognize. Let's bring this down to the household level. Imagine you earn $60,000 per year. That is slightly above the median household income in the United States. In 2020, 1 ounce of silver cost approximately $17. At that price, an hour of work at $30 per hour bought you nearly 2 ounces of physical silver. Today, at $75 per ounce, that same hour of work buys you less than half an ounce. But here's what matters more. The purchasing power of the dollar itself, the unit you are paid in, the unit your savings are denominated in, has declined approximately 20% since 2020. $100 in 2020 buys roughly $80 worth of goods today. That is not theory. That is the lived experience of every person who purchases groceries, pays rent, or fills a gas tank. Now ask yourself this question. If the dollar has lost 20% of its purchasing power in 5 years, but silver has risen from $17 to $75, a gain of 340%, what does that tell you about the relationship between currency and real assets? It tells you that the people who hold real assets are not just keeping pace with inflation. They are multiplying their purchasing power while the majority, holding dollars, are losing it silently. This is not a metaphor. This is accounting. Here is where the story becomes more interesting. Central banks, the institutions that control currency supply, set interest rates, and manage national reserves, have been accumulating gold at a pace not seen in over 50 years. In 2025 alone, central banks purchased an estimated 850 tons of gold. Not ounces, tons. These are not speculators chasing momentum. These are the managers of the monetary system itself. The very institutions that issue currency are choosing to hold physical metal instead of the currency they themselves create. Why would they do that? Because they understand what most people do not. They understand that when national debt reaches $38 trillion, as it has in the United States, and when annual interest payments on that debt exceed $1 trillion for the first time in history, the mathematical options narrow significantly. You can raise taxes, you can cut spending, or you can debase the currency. History shows which option governments choose. And when currency is debased, when more dollars are created to service debt that cannot be repaid in real terms, the value of each individual dollar declines. Not tomorrow. Not in a dramatic crash. Slowly, steadily, invisibly to those who measure wealth in nominal currency terms rather than purchasing power. Gold has risen 66% in 2025. Silver has risen 154%. These are not coincidences. These are signals. And the signal is clear. Real assets, assets that cannot be printed, that have industrial demand, that have been stores of value for thousands of years, are repricing relative to fiat currency at an accelerating rate. Let's talk about historical context, because this is not the first time this dynamic has played out. In 1971, the United States officially ended the convertibility of dollars into gold. The Bretton Woods system, which had anchored global currencies to gold since the end of World War II, was dissolved. From that moment forward, the dollar became a purely fiat currency, backed by nothing other than the credibility and stability of the United States government. In 1971, gold was $35 per ounce. Today, it trades above $4,500. That is not because gold became more valuable. That is because the dollar became less valuable. The ratio changed. Silver followed a similar trajectory. In 1971, silver was $1.50 per ounce. Today, it is $75, a 50-fold increase. But here's the critical point. That increase did not happen overnight. It happened in stages. It happened during periods when monetary policy was loose, when deficits were large, when confidence in currency stability eroded. We are in one of those periods now. The United States Dollar Index, the measure of the dollar AS strength against a basket of foreign currencies, has declined more than 10% in 2025. That is the largest annual decline in over 50 years. This is not a collapse. This is a drift. A slow structural repricing as global markets reassess the sustainability of current debt levels and monetary policy. And when currency drifts, real assets rise. The institutions that manage large pools of capital, pension funds, sovereign wealth funds, endowments, understand this dynamic intimately. They do not wait for confirmation from cable news. They do not wait for silver to hit $100 before they position themselves. They move quietly, early, and in size. UBS, one of the world's largest wealth management firms, projects silver reaching $42 per ounce through June 2026, with potential upside to $47. That forecast was issued when silver was trading at $35. It is already $75. Goldman Sachs and other major banks have raised their precious metals forecasts multiple times in the past year, not because they suddenly became optimistic, because the underlying fundamentals, debt, deficits, supply constraints, industrial demand, have become impossible to ignore. Major mining companies, the entities that extract silver from the ground, are reporting record profit margins, not because they are producing more, because the price of the commodity they sell has risen faster than their costs. This is what happens in the early stages of a structural repricing. The producers benefit first, then the investors who positioned early, then, eventually, the broader public recognizes the shift and searches begin to rise. California searches for silver are rising because people are beginning to ask the questions they should have been asking 2 years ago. Why are prices rising? Why does my paycheck buy less? Why are the people who own real assets getting wealthier while I work harder for the same nominal income? These are the right questions. Now let's discuss supply in more specific terms, because this is not an abstract issue. Global silver production is constrained not by demand, but by the physical realities of mining. Silver is not typically mined as a primary product. Approximately 70% of silver comes as a byproduct of mining other metals, copper, lead, zinc. This means that even if silver prices rise dramatically, production cannot respond quickly. You cannot simply open a silver mine the way you might drill a new oil well. It takes years to develop a mine, and most of the world's easily accessible silver deposits have already been exploited. Meanwhile, industrial demand continues to grow. The solar industry alone is projected to consume 10,000 to 14,000 tons of silver annually by 2030. That represents nearly 30% of total global supply devoted to a single industrial application. Electric vehicles require more silver per unit than internal combustion vehicles. The infrastructure build-out for 5G telecommunications requires silver. Data centers require silver. The energy transition, whether you support it or oppose it, is a silver-intensive process. And that demand is structural. It is not speculative. It is baked into government mandates, corporate commitments, and technology roadmaps that span decades. When structural demand meets constrained supply, price is the only variable that can adjust. And price is adjusting. Let me be very clear about something. This is not financial advice. I'm not telling you to buy silver. I'm not telling you to sell anything. I am explaining what is happening in the market and why certain behaviors are emerging. But I am going to describe the logic that institutional investors use when they allocate capital. They think in terms of risk-adjusted returns. They think in terms of asymmetry. They ask, what is the downside if I'm wrong, and what is the upside if I'm right? In the case of silver, the downside is limited by industrial demand. Silver is not going to zero. It is not going back to $17. The cost of production alone prevents that. The average all-in sustaining cost for silver miners is approximately $20 to $22 per ounce. Below that level, mines shut down supply contracts and price recovers. So the downside, in practical terms, is perhaps a retracement to $50 or $60 in a severe correction. That is a 20 to 30% drawdown from current levels. The upside? If silver simply returns to its historical ratio relative to gold, which is approximately 1 to 60, and gold is at $4,500, silver should be trading at $75. We are there now. But during periods of monetary stress, that ratio has compressed to 1 to 30 or even 1 to 15. If gold continues rising toward $5,000 and the ratio compresses to 1 to 40, silver could reach $125 per ounce. That is not a prediction. That is a scenario based on historical precedent. The risk-reward profile, from an institutional perspective, is asymmetric. Limited downside, significant upside, and a structural supply deficit that supports the thesis over multiple years. That is why positioning is happening now, not later. Let's talk about the difference between paper claims and physical reality, because this distinction matters more than most people realize. When you see the price of silver quoted on financial news, you're seeing the price of silver futures contracts traded on exchanges like the COMEX in New York. These are paper contracts, promises to deliver silver at a future date. The vast majority of these contracts are never physically settled. They are cash settled, meaning no actual metal changes hands. It is a financial instrument divorced from the physical commodity. But something unusual has been happening in the silver market over the past 18 months. The amount of physical silver held in COMEX warehouses has been declining. At the same time, demand for physical delivery, actual bars of metal, has been rising. This creates what is called backwardation. It means that the spot price, the price for immediate physical delivery, is higher than the futures price. That is not supposed to happen in commodity markets. It signals physical tightness. When institutions that hold paper contracts begin demanding physical delivery, and when inventories decline while demand rises, the paper price and the physical price begin to diverge. And when that divergence becomes too large, the market reprices violently. We may be approaching that point, or we may already be in it. The signals are consistent with previous episodes where paper markets disconnected from physical reality. Gold experienced this in 2020 and 2021. Silver appears to be experiencing it now. The people searching for silver in California and elsewhere are not searching for futures contracts. They are searching for coins, bars, and tangible assets they can hold. That is a very different behavior than speculation. That is preparation. Here is the timing question everyone wants answered. Is it too late? Let me answer that with data, not opinion. Silver is up 154% year to date in 2025. That is extraordinary. But it is not unprecedented. In 1979 and 1980, silver rose from $6 to $50 in less than 18 months. That is a 700% gain. In 2010 and 2011, silver rose from $15 to $48 in approximately 12 months. That is a 200% gain. Both of those moves were followed by significant corrections. But both of those moves also occurred during periods when monetary policy was loose, deficits were large, and confidence in currency was eroding. We are in such a period now, and the structural supply deficit today is larger and more persistent than it was during either of those previous episodes. Does that mean silver will continue rising in a straight line? No. Markets do not move in straight lines. Corrections happen. Volatility increases as prices rise. But the underlying thesis that real assets are repricing relative to fiat currency and that silver is structurally undersupplied remains intact. The people who positioned themselves early are already ahead. The people who position themselves now are still early relative to the broader public. The people who wait for confirmation from mainstream consensus will be late. That is not unique to silver. That is true of every structural trend in financial history. Let me leave you with a question. If the institutions that control the monetary system are buying physical gold at the fastest pace in 50 years, if silver is in its fifth consecutive year of supply deficit, if the dollar has lost 20% of its purchasing power in 5 years, if industrial demand for silver is projected to grow by 30% over the next 5 years, and if the national debt is growing faster than the economy that supports it, what are you doing to prepare? Not to speculate, not to gamble, to prepare. Because the people who understand this dynamic are not waiting for permission. They are not waiting for prices to feel comfortable. They are recognizing that the window between recognition and repricing is closing. California searches for silver are rising, not because Californians are smarter, but because California is a leading indicator. It is where technology concentration is highest, where wealth concentration is highest, where awareness of structural trends often emerges first. The rest of the country will follow. The rest of the world is already following. The question is whether you will act on information before it becomes consensus, or whether you will wait until consensus forms and the opportunity has already repriced. History does not repeat, but it rhymes. And the rhythm of monetary debasement, real asset repricing, and delayed public recognition has played out the same way across centuries. The difference this time is the speed. Information moves faster, capital moves faster, repricing happens faster. But the underlying truth remains unchanged. Real assets, assets with tangible utility, constrained supply, and no counterparty risk, preserve purchasing power when currency loses it. Silver is one of those assets. It is not the only one. But it is the one that everyday people can still access at prices that have not yet fully reflected the reality of the monetary environment we are in. That is why searches are rising. That is why institutions positioned early. And that is why the people who understand these dynamics are not waiting for permission from cable news to recognize what is happening. The signal has been sent. The question is whether you are listening.